Almost unnoticed, money supply has been rising here in the UK, while there are variations including cash and non-cash instruments and holdings that are both within and outside the financial sector control. This development is interesting because it means that cash is in plentiful supply. But deep down, what does it mean? Well, John Butler joins us now from GoldMoney Wealth with his thoughts on the matter and ask you that question. What does this mean economically to us here in the UK, this extra money supply?
Well, it's difficult to know with any really exact measurement what the relationship is going to be between changes in the money supply and actual growth or inflation that is eventually realized. But they are related. Economists know they're related. They just disagree about what that relationship is, how strong it is, on what time horizon the two are going to link up. However, when you see very large increases or decreases in the money supply, then there's nearly universal agreement that it does mean something.
What about against the valuation of the currency? My understanding is these boosts in money supply have pretty much all happened before Brexit. Since Brexit, we've seen this big devaluation in sterling. What is the effect of that and the money supply story?
Well, other factors equal, if a currency devalues, that stimulates both growth and inflation in that economy. And of course, money supply needs to rise as part of that process. So other factors equal, when currencies devalue, money supply growth increases. But keep in mind, sterling was already very weak prior to the Brexit referendum. So there was already a reason for the money supply to be surging prior to the Brexit referendum. Of course, the surprise result of that referendum led to sterling getting whacked yet again, and yes, you got yet another surge in money supply, which continues to the present day.
So can we assume then that the economic growth that we've got, the inflation that we've got in the economy at the moment, is in part due to the money supply that's come through, rather than the fact that we're all working harder, producing more and gaining more money?
Yes, the money supply being sort of a transmission mechanism between the real economy on the one hand and the nominal price level on the other. You're absolutely right. But it's important to keep in mind also, the Bank of England also cut interest rates again post-Brexit, concerned about the hit to confidence. But other factors equal, when you lower interest rates, you also boost money supply growth. So in a way, we're adding fuel. The bank is adding fuel to what is becoming a potentially inflationary fire.
Are we talking big numbers here in inflation, or are we talking closer to the Bank of England target? Because, to be fair, the Bank of England is desperate to see inflation move up. So inflation ultimately could be good.
From their perspective, yes. And in fact, be careful what you pray for, because if you take this combination of weaker sterling, this further rate cut that we've seen, the surge in money supply growth, and the existing uptrend in wage inflation that has been taking place for well over a year, if you just extrapolate all of the above, inflation could be as high as 4% by the end of 2017.
Okay, how do we trade this? I mean, what are the tradable opportunities out of this?
I think that if you believe the bank will accommodate the inflation, that they almost want it to go above their target for a while to help erode the debt burden in the economy, for example, then it's you want to short sterling. But what currency do you hold against sterling? Dollars? Well, the U.S. also has its economic issues. Euro? The euro area certainly has its issues with Deutsche Bank, etc. Actually, perhaps gold is the better alternative. So to short sterling, not versus dollars, say, but versus gold, if you can do it that way. That's one idea. The other thing to be concerned about, of course, is the bond market. Beyond a certain point, gilts will get hurt if you see that large a rise in inflation. It's inconceivable, really, that gilt yields can remain where they are today and prices where they are today if inflation gets up into the 3-4% area.
If you're holding assets, my understanding is if inflation goes up, that's positive, isn't it? So what about the equity markets?
It's positive for assets that rise in price with inflation. Some do, some don't. Stocks do tend to rise in price with inflation, but they don't always keep up. Bonds necessarily lose value in inflation, but it's real assets that really shine if you get into a properly inflationary environment. It's not just gold, it's other metals. To the extent property is not already overvalued, property can hold its value fine. And then, of course, other real productive assets, be it whatever it might be, forestry or land or productive agricultural land, say.
Okay, well, interesting subject. But John, thanks indeed for joining us with a look there at the potential reaction to the news that we've seen over the summer, that we've seen this rather large rise in money supply.